Hello students, today we will be discussing under financial management, that is the cost of capital, one part, that is cost of debt capital. As you have seen my other lectures, what is the cost of capital and what is the compositions of your capital structure. What are those capital composition structure? That is your debt capital, preference share capital, equity share capital and return earning. So these are the major four compositions for that. So today we will be discussing under cost of debt capital. So under that cost of debt capital, majority of these points will come these debentures and others. So today we will be discussing one chapter with problem. This is the convertible debentures issue. So you have to be very careful about these debentures calculations for that. Here so many issues are there. Debenture convertible matlab, this might be on the date of maturity, this might be changed to the they will be become the shareholders of the company. All those issues have to be dealt very carefully. You see that here one problem is there. A company issued 10,000 15% convertible debentures of rupees 100 each with a maturity period of 5 years. 5 साल का बाद में उसको maturity हो जाएगा. At maturity, the debenture holders will have the option to convert the debentures into equity shares of the company in the ratio of 1:10. That means for each debentures, 10 shares will be given. The current market price of the equity shares is 12 each, and historically the growth rate of the shares are 5% per annum. Compute the cost of debentures assuming 35% tax rate. So this is the issue is there. Now for this problem, what are the things we have to take into consideration? So for this purpose, debentures issue calculations, first of all you have to understand and calculate what is the debenture redemptions value. Debenture redemptions value, we have to take into consideration higher of the cash value of debentures, or second alternative is the value of equity shares. Value of equity shares, what is that? You see that from the problem itself, your that 1:10, that means 10 shares will be given this thing. So value of equity shares after 5th year on the due date, 10 shares into rupees 12. At present this share value is rupees 12, and there is a growth rate of 5% per annum. So that means that formula wise 1 plus 0.5, that is rate power to the power 5. So 10 into this problem, if you solve it, 1 plus 0.5 whole to the power 5, that will be coming to your 10 into 15.312. If you see that 10 into 15.312, it will come to 153. So value of equity shares on maturity, it will be 153. So thereby 153 will be taken as the redemption value, as it is higher than the cash option. You see that two of the options are there: cash value of debentures at the end of maturity with the maturity period in 5 years, and the convertible value is your 153. So what will be higher of the two we have to take it? So what we will be taking, 153.12 will be taken as the redemption value, as it is the higher than the cash option and attractive in investor. Definitely which will be higher, it will be attractive to the investors. Now we have to calculate the calculation of cost of convertible debentures. You see, whenever we will calculate the cost of alternative debentures, we will have the options before us. See, here we will be calculating two different options under your debenture value. So that is alternative one. Here we will be calculating under using approximation method. So So approximation method is generally utilized for these cases for debenture calculations part. So here you have to calculate that KD equal to cost of debt equal to your I equal to your interest, 1 minus T, T is the tax rate, plus RV minus NP, RV minus NP divided by N is the number of years, N is the number of years by RV minus NP, RV plus NP by 2. It will be the average we have to take it. So here this abbreviation, all those things, I equal to your interest, KD equal to cost of debt, T equal to your rate of tax, RV equal to your redemption value of debentures, and your NP equal to your net proceeds of debentures, or alternative current market value, which were the cases. Market value, and your N equal to your number of years, right? So this is the formula for that. You know that again. KD equal to your cost of capital, I equal to your interest, T equal to your tax rate, RV equal to your redemption value of debentures, NP equal to net proceeds of debentures or current market value, and N equal to your number of years. So if you put this figure in this formula, what will happen? If you put these things, KD equal to, it will be coming this way, your that I equal to your rate of interest equal to your 15 into 1 minus T. Tax rate, what is the tax rate is here? You see that tax rate is 35% tax rate. So you have to, 35 means 0.35 is the 35% tax rate, plus RV equal to means your redemption value. So as you have given the redemption value in our last page calculation, that is 153.12 minus your NP equal to this net, that is net proceeds of debentures. So you see that convertible debentures 100 each with a maturity period of 5 years. So net proceeds will be your 100 rupees divided by RP equal to your RV equal to your 153.12 plus 100 by, here this is N is there, no, this will be 5, so divided by 2. So if you solve this problem, this will come this 0.365 plus minus simply these calculations multiplied by here 100 will be there, as because of this is the percentage is there, so that's why 100 multiply will be there. And if you calculate these things, total your 16.09%. So definitely you will be able to that. Very simple this calculation. 1 minus 0.35 means 0.65 multiplied 15, some figure will come here. 153.12 minus 100, 53 by 12 by 5, one figure will come, and here this is the 253 by 12 into 5, 100 by 100. So this will be 16.09%. So again we are repeating that under approximation method your KD equal to 1 minus 1T plus RB minus NP by N into 100 by RB by NP by 2. So this is the formula you have to keep in memory. Here main issue is there, your redemption value. So that is the vital issue for this type of problem calculations. You see, now we can go for some other alternative method of calculations for this redemption of debentures issue. So we have given the first alternative is your that approximation method. You remember that formula you have to keep it. Second alternative is that using present value. Using present value, second alternative. So you see that what is the present value? Generally you have to discount it. Suppose after 1 year if you get 100 rupees, what is the today's value? So that means time value of money you have to take into considerations, because see, if you cannot consider the today's value with the future value, if you cannot consider future value with the today's value, so you have to take it at par. So that's why the discounting factor will come, or the using the present value concept, NPV, net present value. So here we have to see these things. Net present value concept, our these calculations. First of all, we have to calculate the all present values under different rates of interest. You have to calculate for this thing. So first for calculation of using net present value, you have to take it this way, this figure. This is the year 0, initial year, 1 to 5 and 5 year. Okay. Now you have to see that cash flow. Now you have to see your cash flows. Cash flow. So cash flow initially 0 year, it will be 100 rupees, and 1 to 5 years this will be your that 9.75. So that calculations will be there, and fifth year you will be giving your that the redemption value of debentures. What end you are getting these things? 153.12. Now you have to calculate present value. See, two different rates you have to take it. One is 10% rate we have to calculate. You have to see that where it will be these things. So 10% rate present value, if it is 1 rupee, then it will come to your discounted cash flow. You see that 100 is there, is your 10% rate present value. See, present value, you have to take it 10% and your discounted cash flow. So if it is cash flow 100 rupees and 10% rate, it will be 1 rupee, 1.000, and present value this 10% here discounted cash flow 100 within that way. And these things present value of 10% of this 9.75 would become to 3.352. So that chart present value chart rate, if you see that, you will get it that thing. So then discounted cash flow, both multiply 9.75 by 332, you have to, it will come to your this thing 32.68 and 153.12. Here your this fifth year your present value will be 4.97. So that will become your 76.10. So if you take these things net of that, these two plus and minus 100, this will come 8.78. This will be positive, no? 8.78. This will be, these two figure 32 plus 68, 76 is 108.78 minus 100. this will figure will be 8.78. So this is one form for your present value at 10%. If you do for present value 20%, if you take it, and discounted cash flow, so same line it is actually, this will be the line after that here will come. Since space is not there, we are mentioning for this thing. So here also to 1 rupee 1.000, then your these things discounted cash flow initial year is 100, and then your this 1 to 5 years, these figures will be your 2.991. so this multiply by this figure 9.75, so it will come 29.16, and these things your end year your this way 153.12, and the PV value is your 0.402. If you multiply that 402 into 153, it will come 61.55. So if you sum total, if you see that 29 plus 61, this is less than 1, so it will be, that means less than 100, that means it will be minus figure will come. So how much is that? 9.29. So here what we understand that in discounted cash flow, why we have taken will be two different rates, that will be telling subsequent stages. So we have to take a rate which will be in between of these two rates. So that's why one we have taken 10%, another we have taken 20%, and two levels we have calculated two different discounted cash flows. At 10% the discounted cash flow will be your 8.78 plus, and at 20% level your discounted cash flow net of minus 929. So now we have to go to calculating the using present value concept. This we will be going to the second part, actually using that discounted cash flow concept, that formula we have to put up. So actually this is an IRR method, internal rate of return on cost of debt. So why we have IRR? IRR means in between the two rates. So we have taken 10 discounted rates between 10% and 20%. Definitely this rate will come in between of the two rates, 10 to 20. So we do not know. So in other places we will be discussing what is the internal rate of return. So that is matching somewhere. So that details calculation, that details analysis scope is not that place. So IRR, internal rate of return, IRR equal to IRR by KD means cost of debt. IRR KD equal to cost of debt under internal rate of return. IRR KD equal to cost of debt under internal rate of return. Then here formula we have to see that way. IRR KD equal to your LR means lower rate plus NPVL by NPVL minus NPVH into H minus L. What are those abbreviations tells? IRR KD we have told that cost of debt under internal rate of return follow. Here LR equal to lower rate. Then your NPVL equal to net present value at lower rate. NPVL and NPVH equal to net present value at higher rate. Net present value at higher rate, and H equal to your higher rate and L equal to your lower rate. So everything you know that thing. So LR equal to your lower rate, you know that your this 15% LR 15, NPVL equal to your these things, last pages we have calculated 8.78, that is 10% discount rate. Net present value higher rate, that is 20% rate, this is positive, and that figure it was there minus 9.29. If you see that earlier pages, that figure will be there. H equal to the higher rate is your this equal to 20% and lower rate equal to 10%. So you see that whenever net present value, it will be something between this the two rates where it will be lie for that. So this is the formula we have given for this way. So now we'll place this figure in above. This formula let it be here, and two alternative cases. So your IRR KD equal to below the pair, lower rate equal to your 15%, that is the base rate 15, then your plus NPVL we are taking that thing 8.78 as we have calculated earlier, 8.78 divided by NPVL minus NPVH. L equal to 8.78 minus your NPVH, what is the rate? Minus 9.29. So minus within bracket minus 9.29, right? This will be there. Okay, into H minus L, higher rate is equal to your 20% minus 10%. So this is the case, 20% minus your not 10%, this should be actually lower rate equal to your 15%. So base rate say higher rate we are taking into consideration 15%. So 20 minus 15. So that is the case. So this should be the calculations. This is the percentage form. So if you calculate that 15 plus 8.78 by 8.78 plus hoga 2 minus 9.29 into 20 minus 15 equal to your 5. So if you solve this thing, it will come your 17.43%. That is in between 15 and 20%. That is your 17.43%. That is the IRR method. Your cost of debt capital basing with your discounted cash flow concept, cost of debt. So these are the two formulas you have to keep in mind. One we have discussed under approximation, that formula you have to keep in mind. Second one we have made it your using present value concept. So IRR and present value and IRR both are linked together, because you see time value money you have to take into considerations, and you have to match a figure where you will be the exact rate will come. So that will be your 17.43. So today we have discussed this one of the important areas, that is cost of debt capital. So this way we will be continuing in your that preference share cost and your cost of equity capital. This will our class lectures will follow. If you see that my lecture has some value and it will give that thing, you know that this is a new channel. Please do subscribe to my channel so that it will be well circulated to all, and this will be getting information to all, and you can also like and share also. So we will be ending this video here with the hope to make a new video in the subsequent dates. All your under cost of capital, another 2 lectures will come. One is for your preference share cost of capital, another is your equity share capital, and return earning also. Return earning also within part of your cost of equity capital, another share separate portions that will be discussing. We are ending the video here. Have a good day.